If you've ever found yourself navigating the complex world of personal finance on YouTube, you've likely come across two intriguing strategies: velocity banking and infinite banking, both of which are typically surrounded with controversy of whether or not they actually work. All this information out there can make it confusing in terms of understanding how these strategies actually differ. Well, in today's video, we're going to look into how these strategies greatly differ in terms of their main purpose. We'll take a look at how these strategies work, but also which one aligns best with different financial goals and situations. For those new to the channel, welcome to Concepts Made Simple, where we aim to simplify everyday financial and self-improvement topics. If you enjoyed the content and you're looking for additional content related to velocity banking and everyday financial topics, please consider subscribing to the channel down below. To really understand the difference between velocity banking and infinite banking, it's important to first look at the core purpose of each strategy. Velocity banking primarily focuses on debt reduction and accelerating the payoff of loans, such as mortgages, credit cards, and car loans. It involves using a line of credit, such as a home equity line of credit, also commonly known as a HELOC, or a personal line of credit, to make extra payments on existing debts, reduce interest payments, and pay off debts faster. On the other hand, infinite banking, often also referred to as becoming your own banker, is a strategy aimed at creating a personal banking system using whole life insurance policies. It is primarily a wealth building and cash flow management strategy. Policyholders use the cash value in their life insurance policies as a source of financing for various investments or expenses. This allows people to borrow from their own policy rather than going to a traditional lender such as a bank or credit union. As we can see, the two strategies are using very different financial products to drive their strategy. With velocity banking, it utilizes a line of credit or some form of borrowed funds like a HELOC. On the other hand, infinite banking revolves around whole life insurance policies, which have a cash value component that policyholders can borrow against or use to grow their wealth. So when does it make sense to use one strategy over the other? Well, that really depends on an individual's financial situation, goals, and risk tolerance. For example, if I'm someone who's focused on paying down high interest debts, such as a credit card balance, personal loans, or payday loans, velocity banking is likely more suitable for my goals, as again, the primary focus of velocity banking is to accelerate debt repayment and save on interest. And although you could potentially use cash value from a life insurance policy to pay down high interest debt, the challenge is that it can take a substantial amount of time to build cash value within your policy. And if you pull from your policy's cash value too early, it really does not give the policy time to compound and grow. That is why, if I'm a person who is focused on long-term wealth accumulation, infinite banking may be the more advantageous strategy for me. Whole life insurance policies used in this strategy offer a conservative and tax-advantaged method to grow your wealth over time. If you're somebody who has a lower tolerance for financial risk and prefer a safe and more stable method of accumulating wealth, infinite banking aligns with a conservative investment approach as it offers slow but steady growth. On the other hand, velocity banking tends to be a much riskier strategy. While it can save you money on interest payments and help you pay off your debt quicker, it does involve some key risks, especially if your interest rates rise over time or if you cannot manage the borrowed funds responsibly. As you can see, these are two very different strategies with different primary objectives. However, this isn't to say that no one would ever leverage both strategies, but rather they would be leveraged for different financial purposes. Both strategies attempt to provide access to additional cash, but through different financial tools. With velocity banking, it provides access to cash through a line of credit, which can then be used to pay off debts or cover expenses. On the other hand, infinite banking offers access to cash through policy loans, which are taken out against the cash value of the policy. This cash can then be used for various purposes such as investments or emergencies. All in all, it's important to distinguish between the many different financial strategies that are out there. And regardless of which strategy you're looking to implement, it is always important to do your proper research, speak with professionals, and evaluate your personal risk tolerance to make the best decision for your current situation. If you found this content to be helpful, please give the video a like and consider subscribing to the channel down below for more content related to everyday financial topics such as velocity banking and infinite banking. Thank you for watching, and we'll see you next time.